Okay, good morning to everybody and welcome to another session of our investment banking course. I don't see many people around. Probably this is the morning effect, Monday effect, as it happens in capital markets. But for those of you who are on time, I understand it's time to start. So again, welcome to another session, which is indeed my final session for this module. So we're going to conclude the presentation of the private equity module, and I will leave the floor to Professor Della Ragione during the month of April, and I will have the possibility and the pleasure to meet you again at the end of April for the last module of the course dedicated to corporate restructuring. But we still have to go, and this is the objective of this session, on the final part of the business of private equity, namely leveraged acquisitions, LBOs. We have already started analyzing replacement capital thanks to the speech by Mr. Luongo last week that introduces us essentially buy and build, carve-outs, and indeed what I'm going to show you in this session are some of the technicalities that characterize the business of replacement. So when existing shareholders get out and new shareholders, among others, private equity investors, get in. If you remind, last Monday, I already started analyzing the LBO and the phases of an LBO. Let me just take in the first part of the session to briefly refresh you some of the concepts and then to start from them in order to complete the session. More precisely, the objective of this session is represented by basically a very sketched agenda. So essentially the agenda for the day is represented by the following. First, we have to understand LBOs, leveraged acquisitions, and so the key steps that we go through in order to complete a transaction of this kind. Second element that we are going to analyze is basically to understand how the market is moving for this particular transaction. In particular, what we are going to analyze together is a little bit regarding the prices, and so essentially the multiples that the market is registering right now for this particular transactions, a little bit of market evolution, and so something related to the general market trends. And we will see, indeed, that there are some interesting news that are taking place in the market, also in response to the enormous amount of liquidity and the ridiculous level of interest rate that characterizes current market trends. And then, still, by looking at the market, we will have a look at the key competitors, so the most active intermediaries that are helping private equity investors to complete these particular transactions. After having analyzed the market, we will have the possibility to return to one of the key aspects. What determines value creation in LBOs? So point number 3 will have to do with value creation in LBOs, which is going hand in hand with some of the aspects that were touched upon by Mr. Luongo in his speech. So how a private equity investor can add value to the company where a private equity investor invests money in. And last but not least, point number 4, how to define a proper capital structure when setting up an LBO. So point number 4 will have to do with the definition of a suitable capital structure for a successful, hopefully successful LBO. How to set up a capital structure in LBOs. Okay? I don't think this session will be particularly difficult to be captured. However, there will be some points, some technicalities, particularly here and there, that could require a little bit of increased attention by you guys and from my side. So at any time you have your chat, eventually you can also speak up using the microphone. At any time, please do not hesitate to ask me. Always very glad to address any kind of concern. So now coming to the first point of our session today. The first point is represented by the steps that a typical LBO goes through when it is set up. And I start again from one of the slides, probably the last slide that we left last Monday when we concluded our session. Just a quick refresh. The idea was that an existing company called TICO, that we defined as the operational company, so the company that really is the target of the acquisition, is owned before the LBO by a group of shareholders that are willing to get rid of this company. And this company has been assessed having a value, the fair value of the assets, to be 3,000, a goodwill which has been estimated to be 1,000, existing liabilities of the TICO company to be 2,000. So you can imagine that 100% of the value of this company has been assessed to be 2,000. This is the amount of money that private equity investors, the sponsors of the LBO, have to raise in the market if they want to buy out the company from the shareholders, the existing shareholders of TICO. The first step, as we analyzed last time, to set up an LBO is the creation of the vehicle for the acquisition. This is in all sense a special purpose vehicle, and the name is indicative. It is a vehicle with a special purpose, and the special purpose is exactly to raise money and then buy out the existing company TICO. The new co is aiming at raising in the marketplace an amount of cash which corresponds to 100% of the value of equity. And in order to do so, a three-layer capital structure is set up on the liability side. As you probably remember, the three layers are represented. The first one, the most important, the senior debt for the acquisition, 50% of the purchase price of the equity. Another 20%, it's an hybrid layer represented by mezzanine debt. Mezzanine, as we define it, is essentially a debt with hybrid features, in a sense that is a debt with some equity components. It is mezzanine, so it is in between debt and equity. It is subordinated, so it can be repaid only after the senior debt has been fully repaid. And it includes some options represented by warrants that are given to the mezzanine investors to buy a portion of the equity by other shareholders in a secondary deal, or eventually to contribute extra equity in the company in the form of a capital increase at a later stage. Okay? And this, in our example, was counting for an additional 20%. And last but not least, and this is the part that is interesting for us, the equity component that we have assumed to be essentially 30% of the acquisition price, that in our example, as it frequently happens in real life practice, is composed by a layer sponsored by LBO funds for an amount of 60% of the equity component. So 360, 60% times 600, and then the remaining 40% by the existing management that is reinvesting in the company. So 40% times 600 is an amount of 240. So this company now is ready to carry out the second step of our acquisition, which is, in all sense, the acquisition strict sense. So what is done is that the cash that is raised, this is phase number 2, is spent. So the company spends cash to the existing shareholders of TICO. Shareholders of TICO are out. because they get the money and run away, and shareholders of TICO pays as a contribution for this cash 100% of TICO shares. At this point, as you can imagine, the NewCo controls 100% of TICO company. If you want, the situation at the end of phase 2 can be imagined in a situation of this kind. You have the holdco company, which is the SPV. The name is holding company because it is the controller of 100% of a company called TICO, with essentially its own assets, 3,000, the goodwill, 1,000, its original core liabilities of 2,000, and the equity value of the firm, which is 2,000. So the typical model of an LBO is the typical holdco-opco company model, where an holding company on top is controlling an operating company at the bottom, and essentially remind that the holding company has raised the debt for 1,000 senior and 400 mezzanine to buy out the TICO company. In principle, guys, you can imagine that with the end of phase 2, formally, the acquisition is complete, because now the holding company holds 100% of the OpCo company. And so in principle, if a private equity investor is willing to buy out target company, formally and substantially, the deal could also stop here. Easy, because now you are controlling 100% the target company, that is the cash machine, the company that produces cash. In reality, there are 2 points that I want to draw your attention on. The first one is, going back to our NewCo company, you can understand that the only asset that the NewCo, so the holdco company, has is, in all sense, 100% of the shares, TICO, shares of TICO, whose value is still 2,000. And then we have our 3 layers. So we have the senior debt, 1,000. So we have the senior debt that we have used for the acquisition, 1,000. We have the mezz, which is 400. And then we have our equity of 600. And this is the holdco. 2 elements are important. It is obvious that these creditors here, so the senior creditors of holdco, only can rely on this asset here in order to have their money back, because this is the only asset that holdco company owns. So the first technicality is that, first point, this bulk of shares, 100%, is given as a collateral to the senior creditors of the holdco. So essentially, the TICO shares are given as a collateral, to senior creditors of holdco in the form of what is defined as the pledge on the shares. For Italians, and I know that there are Italians connected, the pledge is impegno on the TICO shares. So in a sense, the senior creditors of holdco are assisted by a pledge on the shares of TICO company. The pledge is an important guarantee because in case the LBO should incur some unintended or unexpected events, the creditors can vote in the general meeting of shareholders of TICO. And so at the very end, they retain the voting powers and so the decision-making possibility to decide what to do, typically in order to restructure potentially that company. Okay? So the first element is senior creditors are assisted by a pledge on the shares of TICO company. The second point instead is a question for you, and I would like to hear your opinion. The question is the following. Why, typically, an LBO can't be stopped at this level? In particular, my question for you is, put yourself in the shoes of a senior creditor here. Can you tell me with what this senior creditor will be repaid principal and interest throughout the life of this senior debt? We are talking about the senior creditors of the holding company, okay? So, if you want to use the chat, I would like you to answer my question. And my question is, which is the only source of repayment for the senior debt of the holding company, the company that now owns TICO company? The cash flows of TICO, correct. To be more precise, I understand, Cesare, I agree with you. Be more precise. It is definitely a cash flow. Give it the proper name. Dividends, correct. Dividends that are paid by TICO to the controlling company. And Andrea, you are hand in hand with Cesare because dividends are a category of cash flows. So you both are right. Let me be more precise. In reality, what can be distributed is dividends. But dividends, as you know, are taken from the net income of TICO. Okay? So dividends of TICO are taken from the net income of TICO. And so, very briefly, if TICO has a net income which is made this way, you have the EBIT of TICO minus financial costs of TICO. This is EBT minus taxes, net income. Assuming that the payout is 100%, this net income is paid to the holding company in the form of cash, and this cash is used to pay back the senior creditor. Super easy. But now, assume that the original creditors of TICO were represented exclusively by one bank, say Deutsche Bank. Assume now that the financing of the acquisition, so the senior debt, is represented by another single bank, say JP Morgan. You can imagine that if you stop the LBO at this level, you can imagine that TICO will pay financial costs and principal. This is the effect on the cash flow statement to Deutsche Bank before JP Morgan can be paid. And in fact, the creditors of the TICO company are always paid first, then the creditors of the holding company, because the holding company is one level above. So the paradoxical situation is that JP Morgan on top can be paid only after all the creditors of the TICO company can be paid. And this is what in finance is called as a structural subordination. So formally, JP Morgan is a senior creditor, but substantially it is subordinated because it can be paid only after Deutsche Bank is paid, because the only source of repayment to JP Morgan is the dividend, so the net income of TICO. Is it right? Is it clear, the concept of structural subordination? Formally, it is senior. Substantially, it is subordinated to other creditors. Tell me, guys, give me a feedback. Is the concept of structural subordination clear to everybody? Structural subordination. Very good. Thanks very much, Andrea. So the point is that JP Morgan can't simply accept this situation. JP Morgan is saying, I'm taking a big take of risk here. And you are telling me that I am subordinated to Deutsche Bank? Simply unacceptable. That's why end phase 2 is only the intermediate phase to the third and final phase. If you think the only solution to make JP Morgan be placed at the same level than Deutsche Bank, legally speaking, pari passu, as they say, is to collapse the two structures, holding company and target company, into one single entity, so that senior and senior are placed pari passu inside the company that produces the cash flows. So, how to collapse the two layers? Via a merger of the holding company in the target company. So, whenever during interviews in investment banking, and this is one of the obvious tricky questions, they say, but why the hell it is necessary to merge a vehicle with an operational company? Well, simply to avoid the structural subordination that senior creditors of the holdco will suffer unless you merge it with the target company. So phase 3 is essentially the merger of the two entities, merger of holdco in with TICO. And typically, the final name of the company will be the original name of the TICO company, because TICO is an operating company. So, going back to our exhibit, we have to merge essentially TICO, this company, with the holding company here. And what happens is that, think about it, NewCo will absorb all the assets of the target. So I will absorb asset 3,000, goodwill 1,000, and the liabilities 2,000, for a net value of 2,000. You have in your asset side a value of the equity stake exactly 2,000, so you will cancel the value of TICO shares. You are consolidating, in a sense, the two balance sheets. And then in the liability side, you will have the original liabilities of TICO, you will have the senior acquisition debt, and so the liabilities of TICO, Deutsche Bank, the senior acquisition debt, the JP Morgan, mezzanine debt, and the new equity, held by the private equity LBO funds, 360, and the management, 40%. So, follow me. The story will be that essentially TICO plus holdco will have the following items. First of all, the old assets of TICO for an amount of 3,000. The goodwill that has been paid for the acquisition, 1,000. The original liabilities of TICO, 2,000. Do you remember? In our example, this was represented by the debt toward Deutsche Bank. Then you have the senior debt of holdco, which was 1,000, and this is JP Morgan. And both these creditors are basically represented by the senior layer. Then you have the mezz for an amount of 4,000, and then you have the equity for 600, owned by 360, the sponsors, private equity, and 240, represented by the management of the company. So basically, the deal now is complete, and as you can imagine, now these two layers of debt are pari passu. So essentially, the idea is that they sit at the same level in the capital structure of this company. Another final element, and then I leave the floor to questions, if any. You can imagine that now JP Morgan and Deutsche Bank are sitting pari passu. So cash flows will be used first to repay them, and then the mezz, and then the equity. However, there is another tricky point. JP Morgan can say, at the very end, I have taken the most important risk of the deal because I have financed the acquisition on top of the already existing creditors of TICO. So if I want the collateral package to be fully guaranteed to me, if you want, I don't want to share the cash flows with other creditors. If I want to get the full control of the cash machine represented by TICO, I want to have the full control of the financial debt of TICO, so that I don't share the cash flows with anyone else. Put it differently, JP Morgan has valued the soundness of the LBO, counting on the cash flows generated by TICO. And exactly for this reason, I don't want these cash flows to be shared with anyone else. Guess what? In reality, when the sponsors, the private equity investors, approach JP Morgan, they will ask JP Morgan, listen, you will not have to provide me only the acquisition financing to create the holding company, but typically what they do, they also ask to refinance the existing shareholders, the existing creditors, sorry. So the idea is that this Deutsche Bank loan will be cancelled, and essentially JP Morgan will finance the full amount of debt, including the refinancing of the existing liabilities. In this sense, as you can imagine, at the end of this deal, not only will be JP Morgan senior to anyone else, JP Morgan will also be the controlling shareholder of the TICO plus holding company. So every potential guarantee, every fixed asset, every floating asset will be granted as a security for the creditor of the combined entity, TICO plus Holdco. Is it clear, guys, why refinancing is necessary? We have said there are two technicalities. First, the merger, and second, the refinancing. The merger is required to cancel the structural subordination. The refinancing is required in order to give the full guarantees only to the creditors that have financed the acquisition process. Tell me if everything is clear or if there is any particular question regarding three steps. Step number one, creation of the vehicle. Step number two, the acquisition. Step number three, the merger in between the vehicle and the operational company. Is everything clear? Luca, good morning, Luca. Just a clarification. Newco and Holdco are exactly the same, right? Correct. These are synonyms. SPVs, special purpose vehicle, Newco, Holdco, holding company, are synonym for the vehicle that is used in order to carry out the acquisition. Okay, Luca? Same for TICO and OPCO, exactly. In legal terms, TICO is the, let me say, convenient name, Andrea, that you use to identify BIDCO and TICO. bid company and target company. From a legal point of view, holdco, opco is the typical label that is used because it refers to the rights of the holding compared to the operational company. Okay, Andrea? Very good. Excellent, guys. Any other question on this part? I think it is pretty intuitive. There is one point that I want to draw your attention on, and the point is the following. If you go back to the original situation of TICO or OPCO, you can imagine that at the beginning of the transaction, the debt to equity ratio of this company was pretty small. Liabilities over equity was 1 time. Okay. If you look at the situation at the end of phase 3, and we assume to consider MES as a quasi-equity, so we calculate the ratio of debt over equity plus MES, you can see that the debt now is 3,000 and the equity plus MES is 1,000. So you have made your leverage to grow at 3 to 1. And this is the obvious effect of a leveraged acquisition. The typical characteristic is that at the end of the day, you make the leverage of this company to lift up. And this is a concern because clearly now you have a much more levered company than before. And clearly you, as a private equity, you are making a bet. And the bet is essentially the following. Either you are able, in a reasonably short period of time, to curb the debt equity down, or second, that the value of the company, so the enterprise value, can be lifted up so that this 3 times debt to equity ratio becomes sustainable in the medium to long term. So at the end of the day, these are really the bets that you are making. Either you can and you must reduce the burden of leverage in a reasonable short period of time, and or, because the 2 bets can also be made jointly, you are able to squeeze out extra value, making this company more valuable in the years to come. So really you are making a bet, and this is a risky bet in all sense. Before understanding a little bit when this bet is less risky, let me just go back to one point. And the point that I want to make before talking about the bet is essentially the composition of the capital structure. So how much is used of the different layers of capital structure to finance a standard LBO? Well, it really depends. It really depends on the moment we are in the credit cycle. When the credit cycle is frothy, at the end of the day, there is a lot of liquidity in the market. The level of interest rate is very low. Credit is cheap. Very much likely the leverage will be lifted up. And vice versa, when the credit cycle is going down, creditors are a little bit more reluctant to lend. The level of interest rate increases. Debt becomes more expensive. And so at the end of the day, probably the default rate of the company is going to increase. And so in this case, potentially the level of leverage will fall. Just to give you an idea, I think that the most obvious thing to do is to look at what the market is showing us. And if we look at some recent numbers regarding the multiples that are used for typical LBOs, and we refer to the US market, you can see what happened from the post-Lehman crisis of 2010 until 2020, so in the past decade or so. How to read this chart? This chart is giving you basically 3 informations. The first one is the continuous line, this one here. that is giving you the indication of the enterprise value EBITDA. So essentially, this is the purchase price of the companies. And the bars instead are indicating you how much of this price is paid in terms of equity component, the pale blue, and in terms of debt. Unfortunately, we don't have the split in between senior and mezz. 6.3. By looking at this chart, guys, just to let me say animate a little bit the conversation. By looking at this chart, which are the most important observations that comes to your mind? Any idea? You can use your chat in order to express your point of view. In particular, look at the three elements: how much you pay for an LBO and how you pay in terms of composition for that LBO. Any idea or any suggestion is more than welcome. No idea? Well, equity contribution is pretty high. Well, I would say, Riccardo, you are right. If we look at the trend, you start from a rather low level of equity, and progressively you have increased the contribution in terms of equity. So from this point of view, the relative contribution of equity has increased. However, I could also have, let me say, a counterfactual element, which is not necessarily counterfactual. Also, the level of debt has increased from 4.5 times to 6.3 times. So also the level of debt relative to the total acquisition price has increased. And this has contributed to an increase of the enterprise value EBITDA. So the idea is, look carefully. There has been an increase of debt contribution, an increase of equity contribution, both of them contributing to an increased enterprise value EBITDA. So the idea seems to indicate that in the last few years, the market has become particularly frothy. Investors, private equity sponsored deal, are willing to pay a higher price for the same companies, and this has been financed with an additional equity contribution and bigger debt contribution compared to the days immediately after the great financial crisis. So in the relative terms, debt is lower, but in absolute terms, debt is higher than the immediately after Lehman Brothers crisis, which seems to indicate that the market is open to pay higher prices. An interesting topic for you guys for a potential thesis. When you are a private equity investor, you don't have synergies when you buy a company. While instead, if you are an industrial investor, very much likely you will pay a price that should take into consideration the potential integration of the bidder and target company, and so synergies. In normal circumstances, industrial buyers could be the winners because they can buy more, exactly because they have synergies. But in markets that are particularly cheap in terms of financial resources, and this is exactly the moment, apparently and paradoxically, a private equity investor could win on strategic investors, industrial investors, simply because they can pay cheap the financial resources they can use in order to overbid strategic buyers. Does it happen only in very specific market conditions? An interesting research question for your final thesis. But this is just to give you some tips. Okay, so American markets, exuberance, multiples are growing, equity is growing, but the leverage has been pushing up compared to the immediately after the period of Lehman Brothers. In Europe, let's see if the situation is mirrored also in Europe. In Europe, the situation again can be shown with the same information. The continuous line is indicating as essentially the purchase price for this company, purchase price, and the bars indicate the composition of that price in terms of equity, the dark blue, and debt over EBITDA, the pale blue. And if you compare the situation of Europe with the situation in the US, you immediately notice that, first of all, multiples are lower than the American ones. So it seems that the market is a little bit quieter than the American one. You also see that in most recent years, also due to the pandemic, debt has been curbed, and so leverage has been reduced rather significantly, and equity has correspondingly increased. But please also look at one thing. The level of leverage today is corresponding to the same level of leverage that we had immediately after the great financial crisis of Lehman. So essentially the market is exactly returning to the point we were immediately after the great financial crisis. So when a private equity investor is looking at a potential target and he looks at the market, these are essentially the typical parameters that we use in order to benchmark the structuring of our leverage compared to potentially other deals, in order to look at the potential sustainability of these deals when we decide to set them up. Okay? So this was just to basically focus a little bit on point number 1 of our agenda. So the phases and the structuring of an LBO. But now let's go back to our bet. So in a short period of time, the bet is successful only if, first, you are able to curb the level of debt over EBITDA or the debt over equity. This is the deleverage option, or to increase the enterprise value. So my point for you is the following, before moving to point number 2. So a quick look at the market. We have already seen the prices and multiples. I wanted to simply give you a look in terms of trends and key competitors. But before doing that, just one point for you. And the point is the following. We said that your bet is either to reduce leverage or to increase the value of the company. Can you tell me which are the typical features that the company must own in order to win this bet? So if you are a private equity and you understand that your bet is successful, either because, first, you curb the debt equity ratio, or you lift up the enterprise value of the company in a reasonably short period of time, which are the features that a successful company for an LBO should boast? Again, open to suggestions. Not all the companies are good candidates for LBOs because they can't stand the potential bet that the private equity investor has made. Any idea is more than welcome. Let's start from the first. You said we have to curb debt equity ratio. Which features should a company own in order to win this bet? Well, let me start suggesting. First of all, it is obvious that you must have essentially potential good cash generation, and or you must be a company which is very liquid. Which basically implies that you could also be a situation where, if you have to win the bet, you have a very low leverage at the beginning. obvious, trivial. If you have a company that is already highly leveraged, which has not a high level of liquidity, and is weak in terms of cash generation, be aware, because this bet can't be won. In turn, good cash generation is probably related to a number of other features. For example, you are a market leader. You have a very good market position. Very much likely, go back to Mr. Luongo, you have a good management team that can take the driver's seat and then execute the financial and industrial plan that the company will go through during the LBO process. Sometimes build up strategies, you must be in a mature market with a low level of growth that you can relaunch with your strategy. Do you remember the eyewear business of Mr. Luongo? They were not performing pretty well. They went through a build-up strategy, integrating the company and relaunching growth. And so, from this point of view, this is something that could help you lift the enterprise value up. Okay? So, not all the candidates are good candidates for an LBO. And when selecting the TCO or the OpCo, be aware of the fact that if you are not successful in curbing debt or increasing the enterprise value, you might have serious problems later on. Okay? Is everything clear, guys, regarding the typical features the typical candidate of an LBO should have in order to be a successful TCO company? Well, if it is clear, we can move briefly on the point number 3 of our market. So, the trends and the key competitors. Well, basically, I don't have much to say, in a sense that when we look at the market for LBOs, essentially what is happening nowadays is that, first of all, I wanted to show you the typical candidates for leveraged loans. If you look at the statistics in terms of the concentration of LBO funds, you will see indeed that there are some of the sectors on top of the league tables that indicate exactly some of the features that we mentioned. We are not talking about companies that are fast growing, incredibly fast growing. We are talking about industrials, for example, utilities. If we exclude sometimes high tech, sometimes this can be influenced by some mega deals. But again, we have materials, we have consumer products. So essentially what Mr. Longo was saying, traditional sectors that we can find opportunities to relaunch businesses and make the businesses still grow. So the fact that the bet is one only in some cases is exactly reflected in terms of the different rankings of the different sectors in the marketplace. In terms of main intermediaries, if you look at the European situation, you will see that in the first 5 positions, you have always the same guys. Some of the top Americans, JP Morgan and Goldman, and some of the top Europeans, BNP, Deutsche Bank, and Barclays. But we have seen these guys to be exactly the same for both ECM and DCM. So from this point of view, nothing particularly strange. So this is some additional elements that I wanted to show you. The other one is the volumes. The volumes, in terms of global volume of buyout at the global level, you can see that starting from essentially the drought peak of the great financial crisis, the situation has rebounded quite rapidly and is now pretty stable. So the volumes of LBOs are pretty stable. We already said that, however, the market seems to characterize by a little bit of exuberance in terms of enterprise value EBITDA. So we have seen that enterprise value EBITDA has increased, and probably this indicates the temptation to overpay. And the temptation to overpay is also reflected in the level of dry powder in LBOs. Look carefully. Dry powder, do you remember dry powder? It is the amount of committed capital not spent yet. So essentially what happens nowadays is that there is a big amount of unspent cash that these funds have available. And probably this cash is not spent exactly because the risk to overpay is becoming increasingly important due to the fact that liquidity is very abundant. And when liquidity is very abundant, interest rates are very low. When interest rates are very low, the discounting factor for cash flows reduces and the potential price for an asset increases. And so the risk to make a wrong bet increases significantly. So essentially the idea is, it seems that a little bit of prudence by these guys is definitely there. However, you can also imagine that if there is such a huge amount of dry powder in the market, and many of these funds are close to the end of the investment period, they necessarily have to invest. And so you can imagine how much effect the 600 billion unused cash can have in terms of prices. There are many opinionists that are saying that there is a mounting bubble also in leveraged loan markets, and this is the obvious effect of what is happening. But there's more. We have seen that leverage has basically increased compared to the great financial crisis, particularly in the US. Another interesting point is that not only leverage is growing, but a growing number of these loans, in particular, this chart is giving you the percentages of loans, syndicated loans, that are covenant light. So they have only very weak protections for creditors, is heavily increasing. So the paradox is that exactly because there is an enormous amount of liquidity in the marketplace, investors probably are willing to pay more, and creditors, unfortunately for them, are lending at more favorable conditions for the borrowers. They ask a lower protection. 84% of loans granted to LBOs are now assisted by weak covenants, so-called covenant light. Okay? So this is something that should make ring the alarm bell. Higher prices, higher dry powder, weaker protections for creditors. Not exactly good days for creditors. And probably someone will lick the wound in the next few years. Okay? Guys, is it clear the concept of covenant light? Covenant light is a loan with a low level of protection for creditors. Paradoxically, creditors are lending more, being protecting less, which is not exactly a good habitat for creditors. Okay? This was just to give you some indications regarding the general market trends that are affecting the LBO market. And we have seen the multiples, we have seen the trends, covenant light, and the key competitors in the marketplace. Let's now move in the final part of our session to the technical part, value creation in LBOs and how to set a capital structure in LBO. Mr. Luongo last week has already mentioned the way a private equity investor can create value in the investee company. But in order to simplify things, I always love to use this chart that I have taken from the presentation of one large private equity investor, a pan-European one, Permira. Just to give you an idea, Permira was the one who carried out the LBO of Valentino and Hugo Boss, or Dr. Martens, among others. So a pretty active investor. In one of the presentations, Permira said, if I look at 100% of my capital gain and I disentangle the capital gain, I will tell you that my capital gain is generated using three strategies. 73% of my capital gains have been generated by a growth strategy. Only 10% is represented by deleverage, and an intermediate value of 17% is represented by arbitrage. We must understand exactly now these three strategies. The first one, leverage, the second one, arbitrage, and the third one, growth. In order to do so, we can use a very simple example that I am sure will help understanding the different strategies. Suppose that we are in time zero and we are targeting an acquisition with a time horizon of T5. Let's assume that the EBITDA of the company at T0 has an amount of 100. Let's assume that we can pay this company at a price of 6 times EBITDA. And let's assume that we assume to use debt for an amount of 500. Okay? As you can imagine, how much will be the equity contribution at T0 by a private equity investor? Very quickly, guys. I buy a company, 100 EBITDA, 6 times EBITDA acquisition price with a debt financing of 500. How much is the equity contribution in T0? Absolutely, 100, correct. Now, you are drafting as a young analyst for your private equity investor, your business plan, and you assume that, and this is the first pure form of value creation, the deleverage strategy. With the deleverage, the bet you are doing is that in 5 years' time, you will have repaid almost all the debt of this company using the cash flow of the company. So let's assume that if your calculations are right, you are able to reduce all the debt in T5. Clearly, if you use all the cash to repay the debt, you will not invest in new products, new services, new markets. So if the company is sufficiently robust to withstand this kind of cure, the company will not perform much better than T0. So let's assume that the EBITDA will remain constant. Let's assume in the meanwhile that the multiple doesn't go through a re-rating. So at the end of the day, the appreciation of the market for that sector will remain exactly the same, 6 times. So my point for you is the following. If you end up your investment with a company that is still EBITDA 100, 6 times multiple, with a debt of 0, how much will be the equity value at the end of T5? And then, how much will be your capital gain? Level of equity at the end of T5. 0 debt, okay, very good. And so, a potential capital gain of 500. Clearly, guys, this is the typical leverage of the so-called barbarians at the gates. You are milking the company, you are squeezing out every possible penny, you use all the cash to pay the debt, nothing more and nothing less. And this is the result. Permira uses only 10%, generates only 10% of its total capital gain by a pure deleverage strategy. Okay? As simple as that. First strategy. The second strategy, going back to Permira, is the strategy that Permira identifies as the arbitrage strategy. So again, a pure financial strategy, typical of private equity investors with a finance mindset, that is exploiting another potential advantage. Let's use the same example. So we have the same example as before. So in this case, we have the second strategy, the arbitrage. We start again our deal with a company whose EBITDA is 100 with a multiple of 6 and a debt of 500. But now we assume that the situation changes. So the starting point is always an equity of 100 with a debt of 500. But our strategy is, I'm looking in the market in order to find undervalued asset. So my bet is that in 5 years' time, for a number of reasons, the market will re-rate that specific sector, because in the meanwhile the sector has gone through transformations, has developed, and so at the end of the day, we can maybe assume that we can exit the investment in year 5 at 8 times EBITDA. And this is a re-rating of the sector. For example, in the old days of renewable energies, renewables were pioneers. Nowadays, they have become the mainstream. And so, exactly because technology risk is lower, because the technology has evolved, there is a lot of demand, and the decarbonization, carbon footprint must be reduced, Paris Accord, 8 times. You can imagine, guys, that if the multiple increases, the pressure to reduce the level of leverage is not so cumbersome as before, because the enterprise value of the company can increase. So arguably, I can also refinance the same debt, because now the value of the company in 5 years' time will be higher. And so, look carefully, I'm not changing the leverage, but you can imagine that in this case, with a company whose EBITDA is 100, with a multiple of 8 and debt of 500, how much will be the equity value at exit for this company? The exit value, as you can easily calculate, is 800 minus 500 refinance debt is 300. And again, you have a gain. And this gain is an amount, 200. Permira uses this arbitrage strategy, contributing 17% of the total capital gain of this company. Also in this case, there is not an hands-on approach. There is simply a bet that the market will re-rate the appreciation of that specific asset. And this is what happens. Again, a pure financial strategy. Buy low, sell high. Okay? Please stop me if something is not clear, but I think it is pretty intuitive. The last strategy, which is the most contributing of all the three, is growth, 73%. If you go back to Mr. Luongo's speech, the case of carve out, the case of build up, it is exactly pointing on growth. I want to buy a company because I want to create a strategy of growth. And this is the approach of industrial-oriented private equity, those with an industrial mindset. And if it is growth, you can imagine how this strategy can work. Let's go back again to our example. With the strategy of growth, the story changes. Because now what you want to do is to intervene in the industrial strategy. And so your objective will try to be a lift up of the EBITDA margin. I don't care about the re-rating of the sector. I can also be happy in having the same level of multiple at entry. And I can also get rid of the leverage because I can also refinance. What I'm interested in is to try to lift EBITDA up. And this is strategy, guys, industrial strategy. For example, lifting EBITDA to 150. You can imagine that if I am lifting up with operational efficiencies, build-up strategies, acquisitions, the EBITDA to 150, I can end up with an enterprise value which is no longer 600 but 900. And with a debt of 500, I can end up, now you know the story, with an equity of 400 and then with a capital gain of 300. In more than 70% of cases, Permira is using a growth strategy. And you can imagine that when the market becomes expensive in terms of credit, or leverage becomes less abundant, this is the only way you can win your bet. So you must be a wise industrial manager working with your management in order to maximize the value of it. Tell me, guys, if the three levers, growth, arbitrage, and the leverage are clear. Currently, the situation is leverage is used to a certain extent, but more and more private equity investors are betting on their abilities to squeeze out value through growth strategies. Tell me if everything is right. It's fine with you. Is everything clear? Crystal clear for everybody? Very good. So now, guys, if it is clear, I have a small example for you. And essentially, I leave you this as an exercise. I will be uploading the solutions this afternoon. So you can have a sort of a brain trainer. And in fact, I call it as an LBO brain trainer. The LBO brain trainer that I propose you is the following. Suppose that you are in T0 and you have a time horizon of T5. Suppose that you are targeting a company whose EBITDA at T0 is 100. According to your business plan, you expect to exit at T5 with an EBITDA of 150. In the meanwhile, you expect to buy this company today at a multiple of 5 times. But you are expecting a re-rating of this sector in T5 with an enterprise value EBITDA at 6 times. And you decide today to finance this company with a debt of 300, and according to your projections, you expect to deleverage the company at a value of 100. So my brain trainer for you is the following. Clearly, you can imagine that the equity contribution for this company at the beginning of this period is essentially 100 times EBITDA minus a debt of 300 is an equity of 200, while instead the equity at the end will be 900 EBITDA minus 100, it will be 800. So essentially your delta plus your gain will be 600. So my point for you with this LBO brain trainer is the following. Can you disentangle this 600 in the 3 components of arbitrage, deleverage, and growth? Just one tip for the brain trainer. You will find the solution this afternoon in Blackboard. Clearly, in this case, you are changing simultaneously the three levers: EBITDA, multiple, and leverage. And clearly, if you change simultaneously multiple and EBITDA, there will be an interaction term. So the delta multiple will interact with the delta EBITDA. And so think about it. It's a sort of a brain trainer. I will provide you the solution this afternoon in Blackboard. It's a nice way to apply some of the concepts that we have analyzed in this session. Okay? Very good. So after the brain trainer, we can conclude our session going back to the original point. We have decided to finance 50% our example with senior debt, 20% with mezz, 30% with equity. But exactly how we can set up a capital structure for an LBO. In order to do so, and in order to address this question, I have prepared an example. And you will be familiar already with this example because it is very close to what we have already analyzed. And so basically the private equity method to calculate the value of the company. This slide, the last slide of your set, indicates that very frequently when we analyze LBO deals, practitioners, bankers, set the level of debt, mezz, and equity in terms of multiple of EBITDA, and set the combination of equity, senior debt, and mezz in terms of a certain debt to EBITDA ratio. The point for us is then to identify which enterprise value EBITDA we can pay given some key parameters available in the marketplace, which is exactly what I'm going to show you with this example. Suppose, for example, this case. Suppose that we are targeting a company in T0 whose level of EBITDA is 100. We go to creditors, and creditors say that for them, the acceptable debt over EBITDA ratio, do you remember, for example, currently, if we go in the marketplace in Europe and we go to banks, banks say that the acceptable level of debt over EBITDA is in the region of 4 times as much. So we go to creditors in order to get debt financing, and the acceptable debt over EBITDA for these creditors is 4.5 times. Of this 4.5 times, we assume that creditors are open to finance 35% with senior debt, and we have the possibility to mount also the subordinated debt of 65%. We assume that the senior is required to be repaid in 5 years, and that, as we know, the subordinated debt paid only after the debt senior has been fully repaid. Okay? These are the terms and conditions. Now, according to our business plan, we expect in the next 5 years the EBITDA to grow at 5% per annum. We assume as a private equity investor to exit in 5 years. We assume, based on our expectations, that the multiple at exit is 6 times EBITDA, and we want, this is our required IRR, a required IRR of 30%. Very much likely it is a very risky sector because 30% is a pretty high internal rate of return. Based on this information, what we have to understand is how much is the enterprise EBITDA at entry and the composition of the 3 layers, the senior debt, the mezz, and the equity component. Okay? So let's analyze the situation. The data for our example are the following. We have a period in between 0 and 5. We know that in time 0, the EBITDA is 100. We know that in T0, we have the possibility to finance a debt over EBITDA 4.5 times. So we know that we can collect debt for 450, 4.5 times 100, and we know that there is a split in T0 in 35% senior here and 65% mezz. So we know that 35% is senior debt, which, if I make correctly my calculation, is 157.5. And we have the remaining 65% represented by junior mezz. And so 450 times 65% corresponds to an amount of 292.5. Now we have already identified two layers of our enterprise value at entry, because we know that debt will be 157.5 and mezz will be 292.5. What is missing is the equity component. But now we can use our private equity method, because we know that at entry the EBITDA is 100. According to our business plan, we expect to have a growth rate of 5% per annum, so that we know that EBITDA in T5 can be something like 100 times 1.05 for 5 years, which basically brings us to 128 million. Okay, so we get in at an EBITDA of 100 and we get out at an EBITDA of 128. According to our business plan, the multiple at exit will be 6 times EBITDA. So I take, in order to calculate the enterprise value, 6 times EBITDA times 128. So the enterprise value at exit will be an amount of 6 times 128, which is 768. How much is, this is the point, the equity value? The equity value will be the enterprise value at 5 minus the existing senior debt minus the mezz. Are you following me? Pretty easy. We know 768. We know that the senior, this is what our business plan is saying, is repaid in 5 years. So senior is 0, and subordinated is paid after senior has been repaid. So if the senior is completely repaid in T5, this means that the mezzanine debt is still existing. And we know that the mezz is still 292.5. 292.5. So the equity value in T5 will be the difference between 768 and 292. Or, in this case, if I made correctly my calculations, 475. 475.5. So you have an equity value in T5 for 75.5. And now you can apply straightforward the private equity method, because if you have an equity value of 475.5 and you require an IRR of 30% in 5 years' time, you discount to present the value with an IRR of 30%, and you get the present value of equity, which is compatible not only with the required debt over EBITDA ratio, but also with the required IRR by the private equity investor, and the private equity, the present value of the equity in T0 will be 475.5 divided by 1 plus 30% internal rate of return power 5. And so if we calculate this value here, the last layer of the capital structure to be added to the debt over EBITDA is an amount, if I made correctly my calculations, 128. So all in all, my capital structure, which is compatible with the amount of debt over EBITDA required by creditors and with the internal rate of return of 30% required by the private equity investor, is 128. So our third layer of the capital structure will be 128 equity. So all in all, we have 157.5 senior debt, 292.5 MES, 128 equity. We end up with an enterprise value at T0, which is 578, which divided by an EBITDA at 0 of 100. Do you remember? The starting point of our calculation was 100. We have an enterprise value over EBITDA paid today for this company to be 5.78 times. So all in all, guys, how to set up a capital structure for an LBO? Essentially, the idea is to go in the marketplace, to look at multiples of debt and equity that are compatible with the current market situation, identify the suitable internal rate of return that investors are looking for their particular investment, and then apply, in all sense, our private equity method that calculates the value of equity today given an expected exit value at the future. Putting them together and dividing it by the existing EBITDA can give you essentially the value of the enterprise value EBITDA today. Got it? Crystal clear? Is there any particular question regarding this example? Crystal clear for everybody, guys? Okay, I have another brain trainer for you, and this is sort of an exercise that you can try to do in order to understand if all the pieces of the puzzle are well taken. Brain trainer number 2. We have said that with a debt over EBITDA of 4.5 times, we end up today with an enterprise value over EBITDA of 5.78 times. My question for you is, let's assume that we are moving upward in the credit cycle. So we are going through a period of exuberance, covenant light, very low level of interest rate, appetite for risk. And so let's assume that the debt over EBITDA that is, let me say, acceptable for the creditors for this particular deal lifts up to 5 times. My brain trainer for you is the following. In your opinion, how will the enterprise value EBITDA will evolve, assuming the same assumptions of our business plan? The intuition is pretty obvious. Given a higher availability of creditors to finance the deal, the enterprise value, of course, will lift up. And this is what we have seen in one of our previous slides regarding the American market. So essentially, what you expect to see is a situation of this kind here. But this is also something that is compatible with a lower level of equity, because at the end of T5, you will have a higher level of mass still to be repaid. And so you can finance with a higher multiple and a lower level of equity, with good benefit for the same IRR for our shareholders. This is the typical case of markets that are going through a period of irrational exuberance. Okay? Any final question, guys, before closing our meeting today? Any question? Any potential doubt to close the session? Okay. I understand that we can conclude the session. Thanks very much for your attention as always. Since this is my last question before seeing you again at the end of the course, and since this is the last week before the Easter break, I wish to you all, guys, and your families and friends, my best wishes for the holiday breaks, and I'm looking forward to seeing you again for the conclusion of the course at the end of April, beginning of May. In the meanwhile, stay safe, take care, and happy holidays to everyone. Bye-bye. Take care.